In this video, we'll show you two stocks that could explode your net worth this year. You are about to see two businesses that quietly dominate their industries, compound value through execution rather than hype, and continue expanding even when economic conditions tighten. One of these companies has built a powerful daily habit into the lives of millions of customers and is scaling a brand that thrives on loyalty and speed. The other has created a global performance-driven identity that blends innovation, design, and premium pricing into a long runway for growth. These are not speculative plays or trend-driven stories. These are companies built to compound over time with durable advantages that most investors underestimate until the upside becomes obvious. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first business, Dutch Bros, ticker symbol BROS. Dutch Bros is not just a coffee company, it is a behavior-driven business built around routine, speed, and emotional connection. What makes this company matter is not the product alone, it is how the company inserts itself into a customer's daily life and turns an ordinary purchase into a repeatable habit. Dutch Bros has engineered one of the most efficient and scalable drive-through models in the entire food and beverage industry. The stores are intentionally small, streamlined, and optimized for throughput. This keeps build-out costs lower than traditional cafes and allows locations to reach profitability faster. Customers are not lingering inside, they are moving through quickly, ordering customized drinks and returning again and again. That operational design gives Dutch Bros a powerful advantage. Higher volume per location means better unit economics. Better unit economics mean more cash to reinvest into growth, and that growth is still in the early innings. What truly separates Dutch Bros from competitors is brand culture. The company has built an identity around energy, friendliness, and connection. Employees are trained to engage customers, remember preferences, and create familiarity. This is not accidental, it is embedded into the company's operating philosophy. When customers feel recognized and valued, price sensitivity drops and loyalty rises. Dutch Bros resonates especially well with younger consumers who value customization and experience. The menu allows for endless combinations, seasonal offerings, and personalization. That keeps the brand fresh without requiring constant reinvention. It also encourages social sharing, which amplifies organic marketing. From a strategic standpoint, Dutch Bros primarily operates company-owned locations. This matters more than many investors realize. Company ownership gives management direct control over execution, quality, and culture. It also allows the company to capture the full economics of each store, rather than splitting profits through franchising. While this approach requires more upfront capital, it creates a stronger long-term compounding engine. The growth runway remains substantial. Dutch Bros has only penetrated a fraction of its potential domestic market. Management has consistently emphasized disciplined expansion rather than aggressive saturation. This approach reduces the risk of cannibalization and preserves store-level performance. Financially, Dutch Bros has delivered strong revenue growth driven by new store openings and resilient same-store sales. Beverage-focused menus typically carry higher margins than food-heavy concepts, and Dutch Bros benefits from this dynamic. As input costs have moderated compared to prior years, margin pressure has eased, allowing operating leverage to gradually improve. One of the most important recent developments is the continued expansion of Dutch Bros' digital ecosystem. The loyalty program and mobile app are not just convenience tools, they are data engines. They allow the company to analyze purchase behavior, tailor promotions, and optimize staffing without resorting to broad discounting. This protects brand perception while enhancing profitability. Store-level economics continue to improve as newer locations ramp faster and operational efficiencies increase. Faster payback periods mean higher returns on invested capital. That is a critical metric for long-term investors. It shows that growth is value accretive rather than growth for the sake of growth. Dutch Bros also maintains a relatively clean balance sheet for a high-growth consumer brand. Debt levels remain manageable, and liquidity provides flexibility during uncertain macro conditions. This financial discipline allows the company to continue expanding without sacrificing stability or over-leveraging. So why could Dutch Bros significantly impact net worth potential this year? Because the market often underestimates businesses that quietly execute. When investors see consistent unit growth, stable margins, and strong customer loyalty during mixed economic conditions, sentiment can shift rapidly. Dutch Bros does not need explosive innovation to win. It simply needs to continue scaling a model that already works. The biggest risks involve execution missteps, labor cost pressures, or expansion into markets that do not align with the brand. So far, management has demonstrated an ability to adapt pricing and operations without damaging customer relationships. That adaptability is part of the moat. Dutch Bros is a business built on repeat behavior, efficient operations, and cultural resonance. Those characteristics create a compounding machine that rewards patience rather than speculation. Before we move on to the second company, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's talk about the second stock, ON Holding, ticker symbol ONON. ON Holding is not just another athletic footwear brand, it is a performance technology company that happens to sell shoes and apparel. What makes this business matter is its ability to combine engineering, premium design, and lifestyle appeal into a global brand that continues to gain credibility with both athletes and everyday consumers. At the core of ON Holding is proprietary cushioning technology that delivers a distinct feel underfoot. This is not marketing fluff. The technology changes how the shoe responds to impact and motion, which improves comfort and performance. That differentiation allows ON to stand apart in a crowded market without competing on price. Customers buy ON products because they feel different and perform differently. This technological foundation creates a powerful moat. It is difficult to replicate, and it gives the company pricing power. ON Holding operates in the premium segment, where customers are willing to pay more for performance, comfort, and brand identity. That pricing power supports strong gross margins even as the company continues to grow. ON Holding has also executed one of the most effective brand positioning strategies in the consumer space. The brand sits at the intersection of performance and everyday wear. That means its products are just as common on city streets as they are on running trails. This dual use expands the addressable market without diluting credibility with serious athletes. Growth for ON Holding has been driven by disciplined global expansion. Instead of flooding markets with inventory, the company prioritizes brand integrity and long-term relationships. Direct-to-consumer sales play a major role in this strategy. Selling directly allows ON to control the customer experience, gather valuable data, and protect margins. Financially, ON Holding has delivered consistent revenue growth supported by strong footwear demand and a growing apparel segment. Gross margins remain healthy for a growth stage brand due to premium pricing and improving supply chain efficiency. Inventory management has also improved, reducing the risk of heavy discounting that often plagues fast-growing consumer companies. One of the most important recent developments is ON Holding continued expansion into international markets, particularly in Asia. These regions represent long-term growth engines driven by rising health awareness, premium brand adoption, and increasing disposable income. ON is entering these markets deliberately, focusing on brand education rather than short-term volume. The company's balance sheet remains solid. ON Holding maintains a strong cash position and manageable debt levels. This financial flexibility allows continued investment in innovation, marketing, and selective retail expansion without compromising stability. In an environment where many growth companies struggle with financing, this strength matters. Innovation remains a central focus. ON Holding continues to invest heavily in research and development to improve materials, sustainability, and performance. Sustainability is not treated as a side project. The company actively explores circular production models and environmentally friendly materials, which resonate with its core customer base and align with long-term regulatory trends. Another advantage is brand storytelling. ON Holding has built an identity around movement, exploration, and human potential. This narrative connects with consumers emotionally and reinforces loyalty. Strong brands do not just sell products, they sell identity. ON understands this deeply. So why could ON Holding meaningfully impact net worth potential this year? Because the market often undervalues brands that combine technology-driven differentiation with disciplined execution. As revenue scales and operating leverage improves, earnings visibility increases. That can lead to valuation expansion even without dramatic changes in growth rates. The primary risk lies in scaling too quickly and losing brand exclusivity. Aggressive discounting or over-distribution could weaken perception. So far, management has shown restraint and long-term thinking. That discipline is exactly what investors should want. ON Holding represents a rare blend of innovation, premium positioning, and global runway. It is not trying to win through volume alone. It is building a brand designed to endure. When you step back and look at these two businesses together, what stands out is not their industry or product, it is how deliberately they are built. Both companies focus on experience over price. Both invest in culture and identity rather than short-term promotions. And both are still early in what could be very long growth cycles. These are not stocks designed to spike overnight on headlines or speculation. They are designed to compound. Dutch Bros compounds through habit, loyalty, and efficient expansion. ON Holding compounds through innovation, premium positioning, and global brand building. Different paths, same objective. In uncertain markets, businesses with strong customer attachment tend to outperform. When consumers feel connected to a brand, they keep spending even when conditions tighten. That is why these companies matter right now. They are not dependent on perfect economic conditions to execute their strategies. Another important takeaway is management discipline. Both leadership teams have shown restraint in how they deploy capital. They prioritize long-term value creation over chasing growth at any cost. That mindset reduces downside risk while preserving upside potential. Investors often talk about finding the next big winner. In reality, wealth is usually built by owning great businesses early and holding them while they execute. That is exactly what these companies offer. They are not finished stories. They are still being written. On Holding represents a rare blend of innovation, premium positioning, and global runway. It is not trying to win through volume alone. It is building a brand designed to endure. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these two businesses do you believe has the stronger long-term competitive advantage and why? Share your reasoning in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.